Good to have you both here. Paul, do you think Chair Powell is prepping the market for a 50 basis point hike, a double, which might come as a surprise?
Yes, I think he is. Essentially today, he sang the same hymn he did last week, but he said it with more feeling. He really was singing today that the Fed's mission is to deal with inflation, and he's going to do whatever it takes, and he's not worried about really buckling the economy short term. So he sent a message, get ready.
So, Liz Ann, is the market going to be okay with it or not? Last week it seemed okay with that message. Today, not so much.
Well, and also last week the market had already heard and I think had digested the notion that every meeting was likely to be live, and that didn't have a huge negative impact on the market. Now that we have a sense that not only every meeting is live, but the possibility of 50, maybe you could point to that, and Powell's more hawkish comments as a reason for the weakness today. But we're just in a volatile period of time, and there are going to be days where it's easy to point to something that might explain either a up move or a down move. Other days, it might not. But I think the only reason why a 50 would really surprise markets is if we were in an environment of growth really, really slowing and the Fed having to push into higher recession risk with a 50 versus if growth kind of hangs in there. I think the stomach for the market in terms of digesting 50 would be a little more palatable.
Well, I think that's the other huge question for the market right now, Paul, which is, can this Fed achieve a soft landing? Powell says it's happened before in the past. What do you think? If they're being this aggressive on inflation, can the recovery stay intact?
I think there's a sporting chance, yes, that he can get a soft landing. And he pointed out that there have been 3 in the post-World War II period, not just one, which most of us remember. So it's doable. It's not a done deal, but it's doable. And I think he's leaning pretty hard on the fact that the labor market right now is stronger than horseradish. It really, really is. So he thinks that he can lean on the interest-sensitive portions of the economy. He can lean on Wall Street and not have a big risk on the job front. So I think it's doable, not a done deal, but doable. And in the months immediately ahead, he simply wants to get the hell away from zero.
I like that stronger than I like horseradish, especially strong. Liz Ann, so what do you do? What do you do with tech stocks? Because they're vulnerable again here, and I see Etsy is one of the bottom performers on the S&P. These are the e-commerce names that rebounded so sharply last week off of sort of depressed levels. Are they still as risky? Now we have seen valuations already contract and sort of catch up with what the Fed is doing.
Well, there's no real they there. I think we have to get out of the habit as investors of looking at a sector like tech through a monolithic lens. There's a whole host of names in there that have a wide variety in terms of fundamentals on the earnings and profit margin side, and in particular on the valuation side. And in fact, since the Fed in last November moved toward normalizing monetary policy, it's more higher quality, more value-oriented factors that have been performing best, even within a sector like tech. So you can put on kind of a lowercase v value cap when looking at stocks and not limit yourself to only the sectors that happen to live in the value indexes. So I think within tech, you want to look for reasonable valuation. You still get, hopefully, a growth kicker, but that high quality wrapper around it. Again, I wouldn't limit a look for value to only the sectors that live in the value indexes.